Right now, India's economy is caught in a perfect storm. On one side, you've got a rapidly weakening currency, and on the other, global oil prices are just soaring out of control. When these two forces collide, you get what we're calling an economic double whammy. So in this explainer, we're going to break down exactly what that means for the country. Okay, so first, we'll define this double whammy and really dig into why it's so damaging. Then, we'll look back at a key lesson from 2022, check out the government's current playbook, and explore India's long-term energy strategy. And finally, we'll ask the big question, is this our new economic reality? All right, so let's dive right into the heart of the problem. What happens when these two powerful economic forces, a weak currency and sky-high oil prices, are pulling in the exact wrong direction at the exact same time? So what is it really? Well, think of it like this. India is fighting a battle on two fronts. The country has to pay for its essential imports, especially all that oil, in US dollars. So when the rupee gets weaker, every dollar costs more. And when oil gets more expensive at the same time, the price of the product itself goes up. It's like getting hit from two sides at once. And wow, this slide really puts some numbers to the problem. Since the start of the year, the rupee has dropped over 5% against the dollar. Now get this, in that exact same time frame, Brent crude oil has shot up by a staggering 73.4%. And these two things aren't just happening at the same time, you know? They're actually making each other worse, creating this massive economic pressure. Okay, so what does this all mean for the country? I mean, why does this hurt so much? This isn't just some abstract problem for economists. It has real, tangible ripple effects on the nation's finances and, ultimately, on your wallet.
And this, wow, this number really shows you the scale we're talking about. This current price spike is expected to add more than $70 billion to India's annual oil import bill. That is a massive, massive hit. That's money that has to come from somewhere, putting immense pressure on the whole system.
And all of that, it feeds directly into what's called the trade deficit. That's basically just the gap between what a country buys from the world and what it sells to the world. And with the cost of imports like oil just skyrocketing, that gap is ballooned to over $310 billion in just the last 11 months.
And this chart, this really drives the point home. Just look at this. The bar for the 2021-22 fiscal year is sitting there at about $192 billion. Now look at where we are now. We've already blown past $310 billion, and we still have a month left in the fiscal year. It just shows you how quickly this thing has escalated. Right, so here's the really crucial takeaway for all of us. This isn't just about government balance sheets. All this pressure funnels directly into inflation. A weaker rupee doesn't just make fuel more expensive, it makes all imported goods more expensive. We're talking everything from electronics to machine parts, and eventually those costs get passed on to, well, you and me, the consumer.
You know, this whole situation might feel new, but it's not the first time India has been in this kind of spot. If we look back to the crisis in Ukraine back in 2022, we can see a really clear parallel that helps us understand what's happening right now.
Yeah, the 2022 crisis was basically a dress rehearsal for what we're seeing now. You can literally see the dominoes fall on this timeline. The war started, crude prices jumped over 42%, the rupee got weaker in response, and the end result? The trade deficit nearly doubled. It's a powerful lesson in how this 1-2 punch really hits the economy.
Okay, so that's the problem. It's a big one. The natural question is, what is anyone doing about it? Let's take a look at the actual playbook the government and the Reserve Bank of India are using to manage this crisis.
First, to really get what's happening, we need to wrap our heads around this key term, under-recoveries. Basically, it's when the big state-owned oil companies knowingly take a loss. They sell fuel at the pump for less than it actually costs them to buy and process it, absorbing that price difference themselves to keep things stable for us. And the sheer size of that loss? It's just staggering. Right now, these companies are losing a combined 2,400 crore rupees every single day. That kind of loss is just completely unsustainable without some kind of major intervention. So, faced with that massive number, the government rolled out a two-part plan. First, on the money side of things, it cut the excise duty. That's a tax on fuel by 10 rupees a liter. And this is a really important point. This cut wasn't designed to make gas cheaper for you at the pump. It was to help those oil companies stop bleeding so much cash. Second, the RBI stepped in to stop people from betting against the rupee, which helps reduce some of the wild swings in the currency's value. The government also has another tool in its toolbox, the windfall tax. See, when global oil prices are this high, it can be incredibly profitable for refineries to just export their fuel instead of selling it here at home. So this tax is slapped on those huge export profits to basically encourage them to keep the fuel inside the country for domestic use.
But these are all short-term fixes, right? The real story is the long game. This whole crisis is forcing a much bigger, much more strategic shift in how India plays the global game of energy chess.
And one of the biggest moves on that chessboard has been this huge strategic pivot towards Russian oil. As you can see, India has become a massive buyer, snapping up 38% of Russia's crude exports. When you add China into the mix, the two countries are buying up almost 90% of all Russian oil sold by sea. It's a fundamental reshaping of how energy moves around the planet.
But listen, the strategy isn't just about putting all your eggs in one basket. India is actively diversifying, buying more oil and gas from places like the US, Norway, and Australia. And on top of that, there's the Strategic Petroleum Reserve. Think of it like the country's emergency fuel tank, a massive stockpile of over 5 million metric tons of crude, which is enough to cover the entire country's needs for about 9.5 days if there's a major supply crisis.
Okay, so we've looked at the problem, the history, and the solutions. Where does that leave us? What's the new normal going to look like in the months ahead?
This quote from a recent report is, well, it's pretty sobering. The experts are basically saying that even if the geopolitical situation calms down, we shouldn't expect oil prices to drop back to those pre-conflict levels of around $65 a barrel anytime soon. The supply chains and shipping routes have been so disrupted that it's just going to take a long time to fix. But, and this is a really important but, there is some good news here. While the pressure is definitely real, India's economy is actually far more resilient to oil shocks than it was a decade ago. Oil imports now make up a much smaller slice of the economic pie, about 3.8% of GDP compared to over 7% back then. Now, that doesn't make the problem go away, but it does mean the economy is better prepared to weather the storm.
And that really brings us to the core dilemma, the fundamental question at the heart of all of this. In a world with crazy volatile energy markets, how does a country like India pull off this incredible balancing act? How do you protect your citizens from high prices today while simultaneously investing in the long, expensive, and difficult journey towards real energy independence tomorrow? That is the billion-dollar question.